Hello everybody and welcome to Chart Room. I'm your host, Griffin Trelaw. Today marks an exciting beginning as we embark on our journey to learn technical analysis. For those who don't know me, I've been trading financial markets for nearly 10 years, co-founded a top 50 market research publication, and even set up the first crypto wallets for retail brokerage here in Australia. Today I'll be introducing you to the first session of our free trading course, The Basics of Technical Analysis. Now this course has been meticulously designed to help you build a rock-solid foundation for your trading journey. Over the coming weeks, we'll dive into the world of charts, indicators, patterns, candlesticks, and much more. So whether you're a seasoned trader looking to refresh your skills or completely new to trading, this course is for you. Without further ado, let's kickstart this educational journey. Grab your notebooks, ask questions, and engage with fellow traders in our fantastic community. Together, we'll navigate this fascinating world of technical analysis. Before we do, however, just a quick disclaimer. Feel free to pause the video and go through the full disclaimer in your own time. However, just remember that trading involves risk and no trading strategy can guarantee profits. Please always consider seeking professional financial advice before you begin any trading activities. Course outcomes. By the end of this free trading course, you would have learnt comprehensive technical analysis skills. You'll understand candlestick taxonomy and its implications. You'll learn to identify candlestick pattern analysis, identify support and resistance, interpret price charts and trends, identify trend continuation and reversals, understand basic technical indicators, learn effective risk management techniques, understand trading terminology, and lastly, master trading psychology. As for the course outline, I tried to be a little intuitive with this by setting an uptrend as we progress through the course, with each module creating a higher high or a higher low. Where else to start other than foundations, because we need to learn to crawl before we can walk and walk before we can run. Learning outcomes for session 1, foundations. We will learn what technical analysis or TA is. We'll cover the benefits and limitations of TA. We'll also cover a basic trading glossary of terms. We'll touch on trading psychology and expand on that throughout the entire course. We'll also go through candlestick taxonomy before wrapping up with an introduction to TradingView, which is the platform we'll be performing all of our technical analysis on. So, what is technical analysis? Technical analysis, or TA, is a method used in financial markets to evaluate and forecast future price movements of assets such as stocks, currencies, commodities, and cryptocurrencies. It is an alternative approach to fundamental analysis that involves analysing historical price and volume data to identify patterns, trends, and potential trading opportunities. The fundamental premise of technical analysis is that historical price behaviour tends to repeat due to human psychology and market dynamics. Traders and investors often use technical analysis to make informed decisions about precise entry and exit points to manage their risk. While technical analysis can provide valuable insights, it needs to be more foolproof and account for fundamental factors, market sentiment, or unexpected shocks that influence prices. Benefits and limitations of TA. In my opinion, they vastly outweigh the limitations, and I'll start off with objective decision making. Technical analysis relies on concrete data derived from historical price and volume patterns, reducing the influence of emotions in trading decisions. Timing, entry, and exit points. Technical analysis identifies optimal trade entry and exit points, improving precision and execution. Trade identification. Traders can identify trends in the market such as uptrends, downtrends, or consolidations, which can guide trading strategies to align with current market conditions. Support and resistance levels. Technical analysis helps pinpoint critical support and resistance levels, set stop loss orders and take profit levels, and identify potential reversals or breakouts. Pattern recognition. Traders can identify chart patterns such as head and shoulders, double tops and flags, just to name a few, which offer insights into potential trend reversals or continuations. Confirmation. Technical indicators and multiple chart patterns can be used to confirm trading signals, increasing the reliability of trade setups. Risk management. Technical analysis provides tools for setting appropriate stop loss levels, determining position sizes, and managing risk to reward ratios. Universal applicability. Technical analysis can be applied across various asset classes and markets, making it a versatile tool for traders. Efficiency. Traders can quickly analyze price charts and indicators, enabling timely market decision making. Backtesting. Traders can backtest their trading strategies using historical data to evaluate their potential effectiveness and refine their approach. Customization. Traders can customize their technical analysis approach by selecting indicators, timeframes, and chart patterns that suit their trading style and preferences. Limitations. Past performance. Historical price data does not guarantee future price movements. Just because a specific pattern or trend played out a certain way does not mean it will follow in the future. Subjectivity. Technical analysis can involve a degree of subjectivity. Different analysts may interpret the same chart patterns or indicators differently, leading to varying trading decisions. Market noise. Financial markets can be influenced by various fundamental factors, including economic events, news releases, and geopolitical developments. In times of high volatility or uncertainty, shocks can be challenging to interpret. Lagging indicators. Many technical indicators are based on past price data, so they may need to adapt to market conditions. When a signal is generated, the optimal entry or exit point may have passed, which is essentially why we don't chase breakouts and wait for a retest. These indicators are good points to pinpoint where a retest shall occur. Over-reliance on indicators. Traders may fall into the trap of overanalyzing and relying solely on one technical indicator to buy or sell. Confluence is critical. Complexity and overfitting. Complex technical analysis strategies can lead to overfitting, where plans are overly tailored and cause analysis paralysis because there's just simply too much on the screen. So use the KISS mantra and keep your approach simple. False signals. Technical analysis can generate false signals where indicators or patterns suggest a specific direction, but the market moves in the opposite direction. This is synonymous with stop hunting and fake outs. Market manipulation. In some cases, markets can be influenced by manipulation or sudden large orders that disrupt the regular patterns and trends observed in technical analysis. Trading Glossary of Terms, Basic. I will cover all these for the sake of it. It's important to understand what they mean or what they infer. Bullish. A bull market is when prices are rising or a rise is anticipated. Now, bull markets are associated with a bull because bulls, when they charge, swipe with their horns up. As for bearish, a bear market is when prices are falling and the sentiment is typically pessimistic. So bears, when they attack, swipe with their paws down. Ask price. The price at which a seller is willing to sell an asset. Bid price. The price at which a buyer is willing to buy an asset. Spread. The difference between the bid price and the ask price. When there's low volume on the order books, the spread price tends to be quite large. When there's lots of volume, lots of liquidity, the spread price tends to be quite small or at a point of equilibrium. Spot price. This is the current price of a financial asset at the exact moment when you want to buy or sell it. Leverage. The use of borrowed funds to increase the potential return of an investment. Leverage requires margin and capital to borrow more for a larger position. Long position. Holding an asset with the expectation that its price will rise, allowing the trader to sell at a higher price. Short position. Selling an asset the trader does not own. So you're borrowing to sell or bet against the market with the expectation that its price will decline. Stop loss order. An order placed to sell an asset when its price reaches a certain level, used to limit potential losses. Take profit order. An order placed to sell an asset when its price reaches a specific target level, used to secure profits. Market order. An order used to buy or sell an asset at the best available price in the market right here and right now. Limit order. An order to buy or sell an asset at a specified price or better, meaning that you're not buying the market rate right now, you're setting a price lower or higher if you're selling. Margin. The amount of required margin or capital used to open or maintain a leverage position in a trading account. Leverage. The use of borrowed funds to increase the potential return of an investment. Volatility. The degree of variation in which an asset's price over time, the degree of variation in an asset's price over time, indicating how much it fluctuates. Liquidity, the ease with which an asset can be bought or sold without significantly impacting its price. Diversification, spreading investments across various asset classes to reduce risk. It's here I'll interject actually. We'll cover the benefits of diversification throughout this trading course. We'll also help you identify risk on and risk off scenarios, and also how to identify sector rotation. So the money just doesn't leave the market, it just rotates from one asset class to another depending on what cycle we're in. And this cycle is largely dictated by interest rates. Bear market, a market characterized by declining asset prices over an extended period. Bull market, a market characterized by rising asset prices over an extended period. Resistance, a price level at which an asset's upward movement is expected to be halted by a concentration of sellers. In theory, as the price of an asset keeps going higher, the supply of sellers willing to sell that asset increases. That is resistance. Alternatively, support, a price level at which a concentration of buyers is expected to halt an asset's downward movement. So as the price of an asset keeps dipping into undervalued territory, the available supply of sellers decreases and the demand of buyers willing to purchase the asset increases. This eventually forms support. Trend, the general direction in which an asset's price moves, such as uptrend, downtrend, or sideways movement. We call this market structure. Margin call, just saying it sends shivers down my spine. A notification from a broker to deposit additional funds into their trading account when the minimum margin requirement is there. Essentially, when you're leveraging, you have a minimum margin requirement to upkeep to keep that position from being liquidated. As the market goes against your position, your available margin decreases and you'll therefore reach a point where you have to top it up, especially if you do not have a stop loss and are at risk of being liquidated. Not a nice call to receive. Trading psychology. There's so many elements of trading that can actually be applied to just general life, and this is again why I actually love trading. It does keep you centered from an emotional standpoint. The aspects of trading psychology. The psychology behind trading financial markets involves understanding the emotional and mental factors influencing your decision-making process. Managing these psychological aspects is crucial for maintaining a disciplined and rational approach to trading. So here's a breakdown of various psychological aspects along with a list of do's and don'ts. Emotions. Fear, greed, excitement, and frustration can significantly impact trading decisions. Discipline. Maintaining a consistent and systematic approach to trading is essential for long-term success. Patience. Waiting for high probability setups and avoiding impulsive trades is a crucial trait of successful traders. Risk management. Managing risk and setting appropriate stop-loss levels are crucial to protect capital. Overconfidence. Being overly confident can lead to risky decisions and trading beyond one's capabilities. Loss aversion. Traders tend to avoid losses or crystallizing losses more than seeking gains, leading to holding a losing position for too long. Confirmation bias. Seeking information that confirms pre-existing beliefs and ignoring contradictory information, meaning that if you have performed your analysis, you believe an asset's price is going up, you buy, it goes down. If you have no risk management in place or no parameters in place, you tend to seek out additional confirmation through other trading ideas to confirm what you're seeing. Not a good way to trade. FOMO. God, I love this acronym. Fear of missing out. Acting on trades for fear of missing out on potential gains often results in poor decisions. You want to be very disciplined with everything that you trade. It's your money. You are risking it. It's a zero-sum game. You either take money off someone else or you lose it and give it to someone else. Revenge trading. Engaging in trades to recover losses from previous positions only or can lead to further losses. Do's and don'ts for trading psychology. Do's. Do develop a trading plan. Create a clear trading plan with entry, exit, and risk management rules. I'll create one for you as we progress through this trading course. Practice patience. Wait for confirmed setups and avoid impulsive trades driven by emotions. If you see a breakout, don't chase it. Wait for a retest, then set your risk management parameters in place. Control emotions, recognize emotional triggers and implement strategies to manage them effectively. Don't trade when you're anxious, when you're fearful or euphoric. Maintain discipline. Stick to your trading plan and avoid deviating from it due to emotional impulses like the fear of missing out. Learn from your mistakes. This is what separates good traders from bad traders. Analyze losing trades to learn from your mistakes and refine your strategy. Meaning that if you lose money due to a strategy that didn't work, don't apply the same strategy hoping for a different outcome. That is the definition of insanity. Stay informed. Keep up to date with market news and data that could impact your trades. Again, another reason why I have built this community, for people to stay informed and up to date with what's happening in the market. I can only do so much, which is why I've also included other professional traders to assist. Do manage risk. Use appropriate position sizing, set stop loss orders, and consider risk to reward ratios. Do's and don'ts for trading psychology. Don'ts. Don't let emotions drive decisions. Avoid making trading decisions based solely on emotions like fear or greed. Don't overtrade. Trading too frequently can lead to losses and increased emotional stress. In theory, the more you trade, the more likely you are to lose money. Don't chase losses. Avoid trying to recover losses by making impulsive trades without proper analysis. Don't ignore risk management. Only risk what you can afford to lose on a single trade. I can't stress that enough. Do not follow the crowd blindly. There's a reason 97% of people consistently lose money. Avoid the herd mentality and make independent decisions based on your analysis. We want to be like Wall Street, not Main Street. Do not neglect self-care. Please, the market will always generate endless opportunities for you to trade. Prioritize your mental and emotional well-being first. Trading can be stressful. Candlestick taxonomy. All right, so we've got two candles here. Both of them mean different things. On the left, we have a white or a green candle. On the right, we have a black or a red candle. The only difference between the two is where they open and where they close. For a green candle, the close price is higher than the open price. So if we look at the time frame, right, let's just assume that this candle is on a 1 hourly time frame, meaning that each candle is 1 hour's worth of trading activity, right? We'll use Bitcoin as an example. Let's say at the beginning of the hour, Bitcoin opened at $30,000. It rose to a high of $32,000 and then closed at $31,000. The close is the price Bitcoin ends at after that hour has elapsed and a new candle has opened. These shadows or wicks are the highest and the lowest price Bitcoin got to within that hour, but did not close at, okay? Look at it like a range. Alternatively, with a red or a black candle, the open was higher than the close. So Bitcoin opens at $30,000 and then closes at $29,000. Similarly, within that 1 hour's worth of trading, price may have gone higher than $30,000, it may have gone lower than $29,000, but it closed at 29 here, okay? So these are the bodies and these are the wicks. Essentially, candlesticks represent human emotions betting on price over time. As the trend continues, these candlesticks form patterns which can be interpreted as bullish, bearish, or neutral. And as we progress through the trading course, we will cover that in much greater detail. Candlestick strength. So, it goes without saying that the least bullish candles or the least bearish candles have long wicks and very small bodies. You can see that with the least bullish ones, right? Price within that time frame went quite high, and then before the close, sellers came in and smashed it, leaving a long upper wick and small body. With neutral bullish, you'll see that the wicks are evenly distributed, with a small body or a decent sized body in the middle representing indecision. The most bullish candles are ones that have large green or white bodies with wicks below them, indicating what's called a hammer or a full body green candle here, meaning that sellers came in to knock the price down before the price then closed within that time frame. The buyers came in to save it. Alternatively, with the bearish candles, again, the close price was lower than the open, which is why they're red or black. Same thing, the least bearish ones have long lower wicks, meaning that buyers have come in to protect it. The most neutral ones are ones where they have a body in the center and an evenly distributed wick on either end. And then the most bearish candles are ones that have full black or red bodies with long upper tails, for example, or just a full red body to indicate that that entire hour from start to finish, or for that entire time frame which the candle took to open and close, was full of selling. Now, moving to TradingView, okay? TradingView.com is the platform we'll be performing all of our analysis on. And just for a quick summary, I will show you how to sign up. I'll take you through the platform quickly. I'll take you through the useful features, and then obviously we'll wrap up by learning how to build a layout and format charts, and then favorite tools and timeframes. So let me quickly pause, pull up tradingview.com, and we'll go from there. Alrighty, so if we just go into any web browser and type in tradingview.com, it will take you to the home page here. As we scroll down, you'll see a market summary with a breakdown of all the different asset classes, editors' picks, educational ideas, video ideas, so on and so forth. I do implore you to, in your own time, go through all of this, but just for the time being, I just want to show you how to format and lay out your charts. Again, when it comes to looking at other trade ideas or editors' picks, we don't want to induce confirmation bias. So learn a strategy first and then start looking at more professional or more experienced traders to understand their analysis. You might learn something new, but do take it with a grain of salt. If it looks too complicated, go back to the basics, master that first, and then you can start spreading your wings. So we either want to go to get started. Now, when it comes to signing up on TradingView, please use a different email dedicated just for trading, okay? Use this for logging into exchanges, brokers, and TradingView. Keep it separate to a personal email because you don't want to commingle spam, especially considering that sometimes you want to log into a brokerage or a trading app using two-factor authenticator. You don't want that email, if the code's sent to that email, to be lost in a myriad of spam because you're subscribed to other mediums. And more so, specifically speaking, if you are leveraging, you get a margin call, you don't get the text notification, but it goes to your email, you want to make sure that that email is there so you can click the link, go to the broker and top it up if you have to. All right, so get started. We just want to sign up using the $0 plan. We can eventually upgrade to allow for more indicators on the chart. I tend to bulk buy my subscription to TradingView, and the best time to bulk buy is around the end of year or Black Friday, where they have 60 or 70% off discounts for a 1-year bulk buy plan. These are also priced in US dollars, and I know the Aussie dollar is not looking too pretty at the moment. So once you've created a new email, you'll sign up. In my case, I'm going to sign in. No, thank you. And all we want to do is just go to the search bar and it will pull up a variety of different assets and their respective tickers. A ticker is essentially an acronym. So for Bitcoin, BTC is the ticker. For gold, XAU is the ticker. You'll also notice that you have other tabs to alternate between ideas. So if you click ideas and then Bitcoin, it will pull up all the Bitcoin ideas, for example, that are either ranked by popularity or recently trending. I do not recommend you doing this until you have learnt a trading strategy on your own. This will cause confirmation bias and will impact the decision you make when it comes to buying or selling. You want to take these with a grain of salt. Go back to the search bar, symbols. We'll just click on Bitcoin for the time being and launch the chart. So this is the generic chart format that everyone will see the first time they sign up and enter TradingView. You'll see the vertical and horizontal grid lines. You'll have the volume indicator down the bottom. You'll have the watch list here, which is actually quite important in my opinion. Keeps track of the indices, the stocks, futures for commodities, Forex and crypto. It's just a quick way to obviously cycle through different assets too. I don't pay attention to any of these technical indicators down the bottom because I like to perform my own analysis. So going back to Bitcoin, before we format the chart layout, I just want to take you through all the different sort of features and a ledger that we'll be using to perform our analysis. So on the top left hand side here, you'll have the search bar where you type in the ticker. You'll also have the time frame, which is very, very important. So when it comes to time frames, and we'll cover this in the following 2 sessions, the higher the time frame, the more data you can fit on the chart, which therefore means the more significant the trend is, okay? The lower the time frame, the more candles there will be, and the less significant the chart will be, okay? Meaning that support or resistance on the 5-minute is nowhere near as significant or strong as support or resistance on the daily. You can use the access for price to scroll up and down to fit more in the chart if you like, or zoom in on it. Now, when it comes to time frames, I'm just going to favorite the most popular ones. They are weekly, daily, 4-hour, and hourly. We'll eventually start going into, let's say, the 15-minute ones eventually. But for the sake of this walkthrough and this light introduction, we just want to favorite these 4. Once you favorite them, notice that they'll pop up on the top here too. So the weekly is great for identifying the overall trend, the daily, then zooming in, and then the 4-hour and the 1-hourly for a more granular view as well. We can also change the different types of trend layout to align. I'm not a fan of that. We want to be able to see people expressing their emotions, which is why we stick to candles. Eventually, and if you like, we can have other professional traders go into how they use hankies for their own trading strategy and what they mean. But for the time being, we don't want to overcomplicate it. And the majority of the market uses candlesticks anyways for their analysis. So we want to do what the rest of the market's doing, because chances are we're all looking at the same thing. It just comes down to how you manage your risk, which gives you an edge over the next person. We'll also go through basic indicators at some point as well. For the time being, we just want to have our time frames at the top there, and we will also have our tools favorited. So the tools I like to use in my analysis are trendline, horizontal ray, I'll leave it at those 2 for now. Keep it really simple. As for tools, Fibonacci is another one that we will also go through at some point in time. Long position, short position, that's great for managing your risk to reward ratio. Brush, arrow, and rectangle, that's a great one too. Now notice, once you favorite those, you'll have a toolbar that pops up the top here. Keep that near your timeframes. Now, when it comes to market structure, we want to look left at the market structure to identify where the support and resistance zones are on the right. For that reason alone, I will move the price scale from right to left, which means if I'm looking at the price, I am always looking to the left of the screen and identifying market structure. Now that we've set this up, we'll actually format the TradingView layout. So in my opinion, because we haven't covered volume yet, we will remove that. And I think this is quite a bland looking chart. I'm not the biggest fan of it. I don't like the vertical grid lines. It's like looking at an Excel spreadsheet. I also like having more defined candle closes and wicks as well. So I'm going to right click, go down to settings, and I urge all of you to follow me. I will change the body to, let's say, a nice looking green. I'll keep it red. I will change the borders to black for both candles. I will also change the wicks to black for both candles. So notice how we zoom in, we have a much more precise open and close. We also have much more detailed wicks. Lastly, what I'll be doing is going and changing the canvas. I will be removing the grid lines, reducing their opacity to 0. And then I also don't like looking at a white screen the whole day. It's like watching paint dry, so I will mix it up and maybe do like a off yellow or something. Or even just a grey. Once you add that colour, it will pop in as a separate tile down the bottom here. We will favourite that. And now we have a much nicer looking chart in my opinion. I can clearly see where the support and resistance levels are. And we haven't even started using trend lines, horizontal rays, or rectangles to find order blocks. So again, with trend lines, the default color is blue. We'll keep that 2px in terms of thickness. Feel free to muck around and change these trend lines to different colors that you like. I tend to do blue. Now with horizontal ray, okay, this is good for looking for horizontal support or resistance. Here's a better example of it now. using the candle closes. In fact, this is again why we look left. We have horizontal support here. Got a trend line with a fake out, a retest, and that breaks down below support. Bitcoin can be nasty. It's a widowmaker. So with horizontal rays, I like to change the ray to the color to represent support or resistance. So in this case, these two rays, we're looking left first. Obviously, we're pretending that this price data or this price action hasn't occurred yet. So we'll keep that green for support. The minute price breaks below our support, it turns into resistance. I'll change that to red. And this is where I also like using the rectangle, because support and resistance won't always just be a specific price. It'll be a block. So here we can see that support had previously held, it turned into resistance. We had a couple of retests before price broke above it. It did come down to retest. It didn't quite do that. This is where we'd use something like the Fibonacci retracement to find golden ratios. Again, we'll cover all of this, but just for the time being, learn to cycle through the different time frames. Get comfortable with just using trend lines to identify support and resistance, or horizontal rays to plot your support. In this case, you'll see that we have lots and lots of wicks, but candle closes on that support. We broke below. Price then retested it and went lower. That's going to be it for the time being. I know that's a lot to digest, and it's a cracking first session, and we managed to keep that within a half an hour. If you want some extra homework, go through the different asset classes and do the same thing. Start with a fresh screen. Plot some support there, for example. Here's another good one that gold recently bounced off. So horizontal support zones are obviously more significant than sloping. Again, this is why it's so important to sit through the entire course first before you know how to identify these things. But just for the time being, learn to play around with the different tools and the different formats for TradingView. Let me now just jump back to the lecture. Alrighty, so that is our TradingView summary. I've shown you how to sign up. I've given you a light walkthrough. We'll also do a more comprehensive one in due time. I've shown you some useful features. I've shown you how to build a layout and format the charts. I've also shown you how to favorite tools and timeframes. Closing remarks. Join the family. Thank you so much for tuning into the first episode. Like and subscribe to the YouTube channel, and hop into the Facebook group in the description below. And more importantly, stay tuned for session 2, which will cover support and resistance.